Welcome. We're going to explore Janet Yellen's recent take on the Trump administration's tariffs. She gave an interview with Bloomberg Television.
Right. And she didn't mince words. Her core assessment was that the entire policy was, well, wrongheaded from the very beginning.
Wrongheaded. So not just the outcome, but the whole idea.
Exactly. A fundamental disagreement with the approach itself.
And did she elaborate on why she felt that way? What about the goals?
Well, that was part of the problem, according to her. She found the objectives quite unclear.
Unclear objectives, and the logic used to justify them.
Similarly problematic. She described the stated rationale as very unclear and not at all logical steps. Kind of a disconnect there.
Right, a disconnect between the stated goals and, well, how they were actually pursued.
Yeah. She specifically brought up the talk of reciprocal tariffs on places like Vietnam and the EU.
Okay, let's unpack that. She touched on the trade deficit argument, didn't she?
She did. And this is key. She strongly believes trade deficits are certainly not a measure or indicator of unfair trade practices.
So challenging a core justification often used for these tariffs.
Directly challenging it. She essentially said, look, the idea that these were just a response to unfair practices, obviously that wasn't the case.
And she gave examples.
Yes, the European Union was one. She pointed out that trade barriers with the EU were already very, very low.
Very low. So imposing new tariffs there. What was the point?
That's the question she raises. It's hard to find a logical explanation if existing barriers were minimal.
And then there was Vietnam.
Ah, yes, Vietnam. This is really interesting. She highlighted that the U.S. had actually encouraged Vietnam to boost its manufacturing.
Encourage them. Why?
For national security reasons, mainly, to lessen the reliance on China, diversify supply chains.
Okay, so if we encourage their manufacturing,
then a trade deficit with Vietnam wasn't exactly unexpected or even inappropriate in that context.
which brings us back to the unclear objectives you mentioned earlier.
Precisely. She stated how difficult it was for her to understand the administration's real goal regarding Vietnam's trade policy, given that context.
Let's shift to China. Yellen acknowledged China had shown some willingness to ease tensions.
Yes, remove some of their own barriers. But then there was the issue of China's retaliatory tariffs, the ones they threatened if the U.S. lifted its barriers.
And how did she view those potential Chinese actions?
As extremely damaging. She even suggested they could make trade almost impossible. Clearly, avoiding that scenario would benefit both sides.
But she didn't completely dismiss concerns about China's economic practices.
No, not at all. She was clear there are some legitimate complaints, things like heavy subsidies for their export sector, especially in advanced manufacturing, and their broader macro strategy.
And she believes those have caused harm to the U.S. economy.
Yes, she stated they have.
So given these complexities, what did she suggest as a better approach?
Dialogue. Addressing these legitimate concerns through discussion and, crucially, working with our allies. That was the established diplomatic way.
Instead of the approach she observed.
Right. She saw the Trump administration taking a more antagonistic stance, even towards close allies, which she felt was, well, less likely to succeed.
This sort of unilateral action.
It really contrasts, in her view, with the Biden administration's stated policy, which is trying to avoid a complete decoupling from China.
And she sees a direct link between the tariffs and decoupling.
Absolutely. She believes if these high tariffs stay, decoupling becomes inevitable. And she sees that as a very undesirable outcome for everyone involved.
Okay, let's talk about the impact here at home. What were her concerns domestically?
A major one was the burden on American households. A considerable burden, she called it.
And she acknowledged things were still unfolding, like the delay on auto parts tariffs.
She did mention that delay, yes.
Yeah.
But the potential overall impact is significant. She cited estimates suggesting the whole tariff program, especially on China, could cost the average household around $4,000 a year.
$4,000, that's substantial. Why such a high cost?
Well, she pointed out that many goods facing tariffs aren't actually made in the U.S., or shifting production here would take, many years.
So consumers feel it pretty immediately through prices.
Exactly. And it's not just consumers. Businesses are feeling the uncertainty too.
How so?
She described them as feeling almost paralyzed. They're hesitant about big decisions, like moving production out of China back to the U.S., because they don't know if these tariffs will stick around. It makes long-term planning very difficult.
And this uncertainty affects our allies too.
Apparently so. She noted a decline in trust, with allies questioning U.S. commitments. Think about it. If a company considers moving to the U.S. to avoid tariffs on goods from another country, They need some certainty those U.S. tariffs will actually remain in place.
Right, that makes sense. Did she see any signs of this economic strain appearing in the data yet?
She pointed to what she called soft data, early warning signs, things like weakening consumer confidence and rising consumer inflation expectations.
Meaning people expect prices to go up?
Yes, consumers becoming less optimistic, anticipating higher prices. Her concern was how quickly this sentiment could turn into hard data, like actual drops in spending.
Which could signal a recession.
That was her worry. She stated a recession is entirely possible and something the Fed would be watching very, very closely.
Even if the hard data hadn't shown major declines yet.
Right, because these leading indicators, the soft data, were already flashing warning signs.
And why are these trends particularly worrisome right now?
Well, she noted that most households were already feeling squeezed by high living costs. Then add the expectation of further price hikes from tariffs.
And those objective estimates pointed to a big hit per household.
Yes, and disproportionately affecting lower-income families because they spend a larger chunk of their income on imported goods.
So the logical consequence would be a drop in consumer spending.
That's the expectation. And with rising inflation expectations, businesses likely become more cautious about investing too. It all increases the recession risk.
So avoiding a recession might require some luck.
That's how she put it, yes. She expected clear signals in the hard economic data soon.
Okay, if the economy does weaken, how might the Federal Reserve respond? She has some experience there, obviously.
Indeed. She reminded us of the Fed's dual mandate, price stability and maximum employment. If the economy weakens, unemployment rises, recession hits. The Fed would likely lean towards lowering interest rates to stimulate activity.
That's the standard playbook.
It is. But, and this is a big but, their ability to do that depends heavily on inflation.
How do the tariffs play into the inflation picture for the Fed?
Theoretically, she explained, one-off tariff increases should just cause a one-time jump in the price level, not ongoing inflation once they filter through.
But
the data was already showing rising inflation expectations. That complicates things significantly.
especially after a period where inflation was already high.
Exactly. There's a risk of what are called second-round effects. If households and workers start demanding higher wages to offset tariff-driven price hikes,
That could fuel more persistent inflation.
potentially yes. And that could actually push the Fed to tighten policy, not loosen it, which would have its own set of economic consequences.
So a really delicate balancing act for the Fed, watching inflation and the job market very closely.
Absolutely.
Did she comment on how financial markets were reacting to all this?
She did. She noted significant moves in Treasury and currency markets, including a weakening of the U.S. dollar,
A weaker dollar. How did she interpret that?
as potentially signaling a decline in confidence, maybe in U.S. economic policy, maybe even a bit less confidence in the safety of Treasury bonds, which is unusual.
How so? Why unusual?
Well, normally during market turmoil, investors rush into safe assets like long-term Treasuries, pushing their yields down.
The flight to safety.
Right. But in this instance, Treasury yields were actually rising while the dollar was weakening at the same time. That's not the typical pattern. Usually higher rates might strengthen a currency.
So that combination is concerning.
She viewed the weakening dollar as possibly indicating a broader erosion of confidence, maybe a shift away from dollar assets.
Would the Fed react directly to the dollar's movement?
Not necessarily directly to the currency itself, she thought, but she highlighted a critical threshold: genuine financial instability.
What would that look like?
Things like serious liquidity problems in financial markets, or the Treasury market itself, or a dangerous self-feeding deleveraging cycle. If things got that unstable, the Fed might step in with liquidity support like they did early in the pandemic, but she stressed they weren't at that point yet.
Got it. One last point she touched on was the debt ceiling.
Yes, and Treasury revenues. She called potential weakness in revenues a very important factor, influencing when the debt ceiling might become a real constraint. She sounded concerned about it.
Even with a seemingly strong economy, revenues could be weak.
She mentioned things like IRS staff reductions potentially impacting revenue collection efficiency, which could affect that debt ceiling timeline.
Okay, so wrapping this up, Janet Yellen's analysis paints a picture of, well, significant concern around these tariff policies.
Definitely. Her main points seem to circle back to the lack of clear goals, the questionable logic, and the very real potential for negative impacts on households, businesses, allies, and the broader global economy. Uncertainty seems to be a major theme.
Thank you for walking us through that analysis. It certainly gives us a lot to think about regarding these complex trade issues. We do hope you found this breakdown helpful. If you did, please consider liking this video and subscribing to the channel.
Absolutely. And perhaps a final thought to leave with our listeners. Thinking longer term, what might be the lasting impact if this period does indeed lead to an erosion of trust, both with allies and within the global financial system? How could that reshape trade dynamics and the U.S. dollar's role in the years ahead?
A crucial question indeed. Thanks again for tuning in, and we'll see you next time.